Yo, yo, yo. Okay, so in this video, we're going to be talking about daily bias. Essentially, what is daily bias? It's just the expected direction of the market for the day you are trading. And the way we are going to be finding out the daily bias is simply by looking at the hourly and the 4 hour. And if you go back to episode 2, market either goes up or down. What are the three ways the market can move? Uptrend, downtrend, and sideways. So we're either going to be catching this or this, and then we do not trade sideways because what you're going to trade here to here? Nope. So it's either going to be going up or down, essentially. Duh. So how do we know it's going up or down? If you go to any market open, London open, is London? Of course it is. So first things you got to do is identify the 4 hour and the 1 hour closest breakout structure to the market open. So what just happened? If you go to market open, you look at all the previous highs and lows and see what broke structure. So we have a high here, low here, high here, low here, and then this low got broken down. So we have a breaker structure right here to the downside on the hourly. That's good. First things first, I would look at the hourly. Why? Because if you're day trading, the hourly matters more because you're within the hour. So the next hour, so the closest break structure, if it's really close, the next hourly is probably going to be with that or pushing with that momentum. But it's also important to look at the 4 hour because the 4 hour is higher time frame than the hourly. And guess what? Higher time frame is always higher power. So we've identified the hourly is bearish. So if you look at the 4 hour now, the nearest breaker structure is in fact right here, which is nice to see. Now, so the hourly is bearish, and the 4 hour is bullish. In this case here, I would actually still be looking for sells. Why? Even though the 4 is bullish, we have a hella oversold. You have to understand this now. This is very important, what I say. If we are in a downtrend, like this, what is a downtrend? Boom, 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 boom. So I will make certain of these smaller just to prove my point. Why can I not draw a downtrend? High, lower, low, a lower high, lower, low, a lower high. So now this, I feel like it's quite common sense, but common sense is not so common. So would you rather catch this move? Oops. Would you rather catch this move or would you rather catch this move? I know which move I'd rather catch. The bigger move, correct. So if you're in a downtrend, you want to be catching the bigger move, the bigger leg. And what we call this? Simple. This here, the smaller move, is the retracement. The bigger move is an extension. So you want to be always trading the extension. So if you've identified you're in a downtrend, you do not want to be catching this move. Why? Because it's a retracement. One thing about retracements are you don't know how far they will run, and you don't know how far or when they're going to reverse. Them two things make it very improbable. What you do know is the extension move, because you're in a downtrend, you're just going to follow the trend. Trend's your friend, and the trend will always be your friend. So yeah, the moment you try catching these small moves like this, you're just going to be losing. So yeah, same thing goes with the bullish. So you get the point. So okay, I can draw a bullish one better for some reason. This is a retracement, and then this long one is the extension. And these are like the two ways the market can move. You want to catch the bigger move. And how do you identify which is the bigger move? You look for the closest break structure. So in this case, I'll have to probably draw that out again. Where's it gone? There we go. So in this case, this forward bullish fair value gap, this forward bullish breaker structure to the high is a retracement. Correct. But for me, because forward is higher time frame, even though we broke structure in the 4 hour, this is actually a fake breaker structure. I don't know if I mentioned this earlier, but fake breaker structure is when we break a high and then we just come back down and we take the low. So we just broke a high for no reason and we straight away come back down and take the low. Now, the issue with breaker structures is a lot of people trade purely off of breaker structures although it does work, me personally, I actually wouldn't be mixed bias for this. So for example, you in this case, you would be 4 hour bullish, 1 hour bearish. So you'd be mixed bias, more leaning towards sells because the 1 hour is bearish, and you're trading on the hourly or intraday trader, so you lean towards sells. However, on the what matters as well is structure. What is price respecting? So if you woke up on what is Thursday? If you woke up on Thursday and you woke up and you've seen, okay, we have a 4 hour bullish rally up which got disrespected. Okay, that's very important because if a rally up's getting disrespected, that means there's some kind of seller in the market. You understand? Then we've also got this huge bearish rally up that's still with it getting respected or like still impending to get respected. So for that reason, I'd be mixed bias. Then you go into hourly, and hourly again is nearest break structures here, and then we also have a fake break structure right here as well. So we break above this high, and then straight away we sweep this high, and then we sweep come straight for this low, like, and then again after sweeping this high straight to the low, it's like this move here, like this movement, it's like so clean. Look at this movement, 300 points with like almost no drawdown, and that's what you want to catch. That's the moves you want to be in, and so yeah. I'll just go over like a few more examples, but that's pretty much it. I don't want to go into entries and all that. That's the next episode. But yeah, let's just go to a random London session. I want to try find one where they obviously align and then it makes it easy and simple. So yeah. What am I doing? London. Here. It looks like here the 4 and the 1 hour was bullish. 4 1 hour bullish. Yes, we just swept a high time frame. That's a very bad example. Let's just check out this. But the issue is with this, I won't say strategy, I won't say issue either, but the problem is when you're facing like the trendy trades, if that makes sense. Like my favorite trades are when the 4 hour and the 1 hour are aligning, obviously, because it's the most easiest, the most clearest to see. When you have a clear draw and a clear bias, it's the easiest trades. So how would you look for them trades? You just wait for the 4 hour and the 1 hour to be in sync. In this case, boom, I can already see 4 was bullish. Go into the 1 hour. London session opens, and then we have to look at obviously 7 a.m. So it's prior to London session. We did not break below any lows. There's a low here, but it's not a break. Boom, boom, boom. There's a high here, but that's again that's 8 a.m. close that does this, so we can't really count that. So it's literally the previous would be here or here, which again it's fine. So we're bullish now on all time frames, and look what happens. Literally, whenever we're bullish on all time frames, the probability, or whenever we're in sync on all time frames, the probability increases a lot. And I know people who don't even trade when it's a mixed bias. And if you do that, your win rate increases a lot, like a lot. And your discipline needs to be really good, of course. And when it does the 4 on the 1 hour line, I wouldn't say barely any time, but probably like maybe once a week, or like yeah, that probably on average about once a week. But I think that's enough, or like twice a week max. The 1 hour on the 4 hours lining, which is fine because I've seen weeks in the past like, and I talk about all of this in my weekly recaps. So I talk about like all of these concepts in my weekly recaps, and I've got all these videos, like plenty of content since July. But that's pretty much it. Extension retracement, closest breaker structure to the market open. The 4 on the 1 hour, remember it has to be the closest. So what that means is, let's have a look at another example. So this was Friday. The closest breaker structure to market open. You might be thinking, oh, it might be this. It might be this, like if we broke structure to the downside. Oh yeah, I see that. Wrong. It's actually this. Like stuff like this you might not see, like it just takes time. This is obviously obvious, but this move here is a small break structure, and then what we get a retracement into probably a high time to failure up, and then we just dump down. probably the exact same thing happen. And here again, look, in this case, you'd still be in this fair value gap. So until like 7 a.m. opens and we've done this and we've gapped down and whatnot, we're still within 4 hour inverse. We've broke structure hourly, and then the 4 hours still, I think, bullish because we didn't break structure yet. And we finally break structure here, and we left behind 2 fair value gaps now. Obviously, which fair value gap do you want to aim for? You want to aim for this fair value gap, and you want to go for down. So it's just really that simple. And it always comes down to market structure, extension retracement. You are always in extension retracement because you are always in an uptrend or a downtrend or consolidation. So you will identify whether you're in an extension or a retracement move, and if it's a continuation, or I'll talk about this in the next episode, and we can get down to the entries and how we can piece everything together. But yeah, that's pretty much it.